Hello everyone and welcome to today's video. I'm excited to dive into the first part of a series where I'll be discussing the 10 golden rules of winning traders. It's important to note that while investing and trading both revolve around the financial markets, they are fundamentally different activities, often requiring contradictory approaches. So, if you're ready, let's get started. In this video, I'll cover the 10 essential rules that successful traders live by. Before we jump into the details, it's crucial to understand that the strategies for investing and trading can be as different as basketball is to golf. While both sports involve balls, the rules are entirely different. Similarly, the rules of investing and trading differ because they focus on entirely different goals and methodologies. For instance, in investing, if the price of a stock drops, you might want to buy more to average down, especially if it's a fundamentally strong company. In trading, however, you would typically cut your losses immediately when the price drops by a certain percentage, because trading involves managing risks in a much more short-term and tactical manner. Think of investing like getting married. You want to marry someone with good character and strong values, just like you want to invest in businesses with strong fundamentals and long-term growth potential. On the other hand, trading is more like a one-night stand. You're not looking for a long-term commitment, but rather a quick, profitable encounter. In this case, it's about finding opportunities where you can anticipate price movements, even if they involve companies or assets you wouldn't hold on to in the long term. As we go through these rules, I'll be focusing specifically on the strategies and assets suited for trading, where the goal is short-term profit. Rule 1: have a well-defined trading plan. The first golden rule of trading is to start with a well-defined and written trading plan. This plan should include the specific strategies you intend to use, which might vary depending on the market conditions. For instance, you might employ a trend retracement strategy during an uptrend or a mean reversion strategy during a sideways market. The key is to ensure that each strategy you choose has a statistical edge, meaning it consistently leads to a net profit over time. In your trading plan, clearly outline 3 critical components: your entry rules, exit rules, and position sizing rules. Your entry and exit rules should be based on both technical and/or fundamental criteria, while your position sizing rules determine the percentage of your capital you're willing to risk on each trade. Rule 2: ensure your strategy is profitable. The second rule is to confirm that your chosen strategy is statistically profitable. This involves calculating your expected profit per trade using a simple formula that takes into account your win percentage, average win, loss percentage, and average loss. A profitable strategy should yield a positive expected profit per trade over a large sample of trades. Rule 3: follow your rules consistently. Once you have your trading plan and are confident in its profitability, the next and most challenging step is to consistently follow your rules. Discipline in trade entries and exits is crucial, and you should only make trades when all the conditions of your strategy are met. This consistency is what separates successful traders from those who struggle. Rule 4: prioritize risk management. Moving on to rule number 4, which is crucial: always focus on limiting your risk. The primary difference between professional traders and amateurs is their approach to risk. Amateur traders often enter trades with excitement, thinking about the profits they might make. This mindset is dangerous. Professional traders, on the other hand, ask themselves, how much am I prepared to lose if this trade goes south? They understand that losses are inevitable, and trading is, in essence, a business where losses are simply the cost of doing business. Before a professional trader enters a trade, they already know where they will exit if the trade doesn't go as planned. This approach is akin to the strategy Jason Bourne uses in the movie The Bourne Identity, where he always identifies the nearest exit as soon as he enters a room. Similarly, in trading, you need to know your exit points in advance, both where you will cut losses and where you will take profits. Set a predefined stop loss. Every trade must have a predefined stop loss. Calculate your maximum loss per trade, which should ideally be no more than 1 to 2% of your total capital. This doesn't mean your position size is 1% of your capital. Rather, the risk you take on each trade should only amount to 1% of your capital. How to calculate position size. Let's break down the calculation. Step 1, determine your risk per trade. Let's assume it's 1%. Step 2, multiply this by your current capital. If you have $10,000 in your trading account, 1% of this is $100. Step 3, identify your risk per share, which is the difference between your entry price and your stop loss price. For instance, if you're buying Bank of America at $30 and your stop loss is at $28, your risk per share is 2. Step 4, calculate the number of shares to buy by dividing your risk per trade, $100, by your risk per share, $2, which gives you 50 shares. In this example, you'd purchase 50 shares at $30 each, totaling $1,500. Although you've invested $1,500, your risk is only $100 because your stop loss is set to limit your potential loss to that amount. Why risk small percentages? Even the best traders know they will face losing streaks. For example, with a 50% win rate strategy, you might experience 16 consecutive losses at some point. If you risk 1% per trade, a 16-trade losing streak would result in a 16% drawdown, which is manageable. However, if you risk 5% per trade, a similar streak would result in an 80% drawdown, potentially wiping out your account. Even strategies with a 90% win rate can encounter losing streaks. If you risk too much, you could face devastating losses during these streaks. The key is to survive the losing streaks so you can capitalize on the winning streaks when they come. Rule number 5, be disciplined in exits. Just as you must be disciplined with your entries, Rule number 5 emphasizes the importance of being disciplined with your exits. Exit when stop loss is hit. Honor your stop loss without exception. Moving your stop loss to avoid taking a loss is a dangerous habit that can lead to much larger losses. Take profits wisely. Avoid taking profits too quickly. While it may seem wise to lock in small gains, consistently taking small profits can undermine your overall profitability. Your winning trades must generate enough profit to cover your losing trades. There are various ways to take profits. Some traders set predefined profit targets, like 2R, where R is your initial risk, while others use trailing stop losses or exit when certain technical conditions are met. The method you choose isn't as important as being consistent with it. Rule number 6, focus on process over outcome. Winning traders focus on executing good trades, knowing that profits will follow if they adhere to their rules consistently. What is a good trade? Good trade, one where you followed all the rules of your strategy, regardless of the outcome. Bad trade, one where you broke the rules, even if you made money. A bad trade that results in a profit can reinforce negative habits, leading to greater losses in the long run. For example, moving a stop loss down might save you on one trade, but in the future, this habit could lead to catastrophic losses. Accept losing trades. Losing trades are part of the game. Even the best strategies have losing trades. A trader with a 50% win rate will lose half of their trades, but as long as the average win exceeds the average loss, they will be profitable in the long run. Rule number 7, be patient and selective. Patience is a virtue in trading. You don't have to trade every day or even every week. Winning traders only take trades that meet all their criteria and are of high probability. New traders often fall into the trap of overtrading, thinking that more trades equal more profits. However, forcing trades often leads to losses. Know when to do nothing. Remember, doing nothing can be a strategic move. If no high-probability trades present themselves, it's better to stay out of the market than to force a trade. Rule number 8, think in terms of probabilities. Trading is about probabilities, not certainties. Even with a profitable strategy, you will have both winning and losing streaks. Understand the law of large numbers. Over a small sample of trades, anything can happen. You might start with a losing streak, which can be disheartening, or with a winning streak, which can create a false sense of security. The key is to think long-term. Over a large number of trades, a statistically profitable strategy will generate a positive return, but only if you stick with it through both the highs and lows. For example, if you have a 50% win rate strategy, over 100 trades, you'll likely have 50 winning trades and 50 losing trades. Your profitability depends on maintaining discipline throughout this entire series of trades. Stay tuned for the next part of the video, where we'll cover the remaining rules. Thank you for staying tuned. If you have not already subscribed, please do, so you will be notified with our subsequent uploads. Also like, share, and comment. Do have an awesome day.